So 2024 was not necessarily a bad year per se, but it could have been better. You would probably already know that I'm a pretty big bull in terms of the Chinese/Hong Kong market. And I think my portfolio sharing across the years have also reflected that view of mine. And my largest two portfolio positions individually has namely been Alibaba and Tencent. And as you can see, on a year-to-date basis, Baba is up 7, Tencent is up 40 plus, and Haidilao, which is my third Hong Kong position for some time now, is up 21% year-to-date. So Alibaba, being my largest position and being one of the biggest laggard across the different positions, have inevitably kind of brought down the portfolio performance for good or for bad. So this is currently the snapshot of my current holdings. And as you can see, China still makes up a very big weightage. I'm clearly very overweight. On a cost basis, I allocated roughly 69%. It was not intentional. But on a fair value basis, purely because the China position kind of sink in value, while my US stock positions actually went up in value. That's why on a fair value basis, China is now 58 and USA is around 42%. So I think just to keep you up to date, this is a snapshot of my current holdings. Just keep this in mind. And just 1.5 months ago, this was my portfolio. So what changed? I think the most obvious one is that if you were to compare the two portfolio snapshots after 2 months, I basically cleared out all my Singapore REIT positions. And as you can see, 1.5 months ago, Singapore was roughly 3%, and now it basically zero rise. More importantly, I also reallocated some monies from my existing position, mainly one lot of Haidilao and one lot of Tencent. And I repositioned or reallocated them to start a position in Moutai, which is now my third largest single stock position. And more importantly, I continue to add to Google, Amazon, and LVMH in the last 4 to 5 months of the year. And here's a snapshot of my past transactions for my US portfolio over the past 4 months since August. And as you can see, I basically just added 3 main stocks: Amazon, Google, and LVMH, if we exclude Oxy and VOO, which is tracking the S&P 500. Clearly, I think considering the current market backdrop when stocks are basically just all going to the moon, and interestingly, I think for those of you who do follow mega cap stocks in Europe, I think they all across the board have not been performing well in 2024. The second part of the update, let me talk about why I sold my Singapore REIT position. So just some context, it was roughly 3% of my portfolio and it made up of around 6 to 7,000 Singapore dollars. And they were mostly accumulated in early 2024 or early to mid 2024. And there was only one small position that was accumulated in late 2023. Initially, these were my investment thesis when I bought into Singapore REITs. I think the REIT asset class has been in a trough for some time, and if you use conventional metrics like price to book ratio to value some of these assets, most of them are trading at like 0.7, 0.8, 0.9 book value, and they are definitely on the low side of history. If you do standard deviation analysis, most of them are probably near the 1 standard deviation. So investors can probably look forward to some sort of potential capital appreciation if they just go back to normal. And it's really just simple math calculations. At 0.8 book value, let's say the average is 1, so you get that 20% capital appreciation. Of course, not including all the dividends that they're going to issue out. And on top of that, I guess the upcoming rate cut, it was one of the very big hoo-ha things amongst the investment community. It will definitely ease the burden of the interest costs, and as many of these are leveraged companies or entities, they would definitely benefit from that. And of course, for myself, at least I'm in the dividend irrelevance camp, because to me, I do think that it's a left pocket, right pocket thing. So my bottom line is simple. I just want to focus on the business assets and the economics of the business itself. So I primarily, most of my REIT exposure, I just want to own or indirectly own some of the prime real estates in Singapore, both from a commercial point of view and also many of the malls, and to tap onto the consumer demand and spendings. So then you might ask, why did I exit my positions and what changed? Of course, you can go on or go down the path of talking about opportunity costs. The Singapore REITs have not performed over the last year or so. And just some background as well, based on the dividends I collected over the last 1 year and the price fluctuations, I essentially broke even. I was slightly green. It was like, I think $50 or $100 up, but it's nothing substantial. So firstly, I think the relative attractiveness of the REIT asset class have deteriorated from my own point of view. I think the first point is really an episode that I have took away from one of the fellow Singapore finance influencer, which is AK71, and his analysis of the REIT asset class versus other types of Singapore-based assets. He was saying that, look, any of the REITs that you look at the market now, I think those strong ones with very strong sponsors, they are giving out 5 to 6% dividend yield. And they are basically issuing out 90% of their income from their operations. So it goes to show that their balance sheet is weak because they don't retain a lot of their earnings. And whenever there is some issues that come up, they always issue out rights to raise capital. So in a way, if you don't take up the rights issue, you'll be diluted. On the other hand, if you look at the Singapore banks, for example, they only have a 50% dividend payout ratio. So meaning to say, they are already paying out 5 to 6% as well, comparable to the REITs. But that's it. Their earnings yield is actually double of that dividend yield, meaning they earn roughly 10 to 12%, and they give out 50% and they retain 50% for growth, for whatever other things that they have. If I just want to focus on the business assets and the economics, clearly the Singapore banks are extremely superior compared to the REIT asset class. And rightfully so, because they are trading at a much higher price to book premium and they are valued a lot more richly. I think all things considered, I would then be more interested in owning Singapore banks rather than Singapore REITs, although there is this sort of capital appreciation upside. The second part, I think, is really the context of how REITs play into my portfolio for myself. I think I'm still relatively young. I should focus on increasing my capital size, or at least don't be too fixated in the dividend yield, because largely speaking, even if I have $6,000-$7,000 invested at a 5% rate, how much is it going to pay me? A few $100s a year. And the last reason, which I think is the most important factor that basically triggered my cutting of my REITs position, is the idea of rate cuts and rental revision. It might take a much longer time than expected. So when you look at a REITs presentation or earnings summary, they tend to show this slide that explains the debt maturity profile. And I think it's part of the normal business for them to diversify and to not lump everything together, so they'll spread out their debt. So similarly for the contracts for their customers or all these people that are renting their places. And yes, we can argue that in the long run, I think if we look at the rate cuts and the expected interest rate outlook, and more importantly, the whole inflation idea, that's why they can revise their rent upwards, because they own some of the most prime real estate in Singapore. But that said, I think the timing and also especially the interest rate outlook and the path ahead for growth is highly uncertain. And not only uncertain, I think it takes a lot of time and a lot of guesswork, which I myself am quite clueless about. So I do believe that in the long run, you can probably still make money from the upcoming recovery, especially from the reversion to the mean. But maybe it's just not for me, at least for now. So to add on to the sales of the REIT position, I also sold out one lot of Tencent and Haidilao. And this is the status of the individual positions. And as you can see, I recorded the date and the price that I sold. I think for Tencent, my average price after accounting for the sale right now is roughly $2.98 per share. And Haidilao, after accounting for the sale, is roughly $14.60 Hong Kong dollars per share. So where did the money go? So the Singapore REITs, I basically managed to fetch around 6,000 Singapore dollars, probably break even, a little bit of profit there. And one lot of Haidilao and Tencent is roughly 9,000 Singapore dollars. So I added all of them to one lot of Moutai, and one lot of Moutai is worth around 150k renminbi, which is 28k Singapore dollars. So I essentially topped up 13k Singapore dollars with the idle capital that I have, mostly from the China bank sales from July of 2024. So I think there'll be a few questions coming up, and I'll just try to briefly answer them. So why the need to sell Haidilao and Tencent? Or why the need to sell in the first place? I think clearly the need to sell in the first place is that I do have extra capital sitting on the sidelines, but is it 28,000? I believe not. It was closer to 20k. So I definitely needed to raise some cash from somewhere. And also a practical reason is that because I have multiple brokerage accounts, some of them have some FX conversion fee or some withdrawal fee. Why did I sell Haidilao and Moutai? What was my consideration? Simply put, actually I think Haidilao and Moutai are in the same kind of industry. They're in the consumer discretionary. They are very sensitive to the Chinese consumer demand. And for those investors out there who do follow the consumer discretionary space, you know that every time there is some sort of a fiscal stimulus or announcement or rumors, many of this stock will jump. So I can technically say that they are in the same industry, but they do target different kind of audience. More importantly also, because Haidilao is a lot smaller compared to Moutai. Moutai has a $260 billion US market cap. Haidilao is, I think, 90, 100 billion Hong Kong dollars. So I think the delta or the movement or volatility for Haidilao is a lot bigger. And also because it's Hong Kong listed, so all the foreign investors can trade, while Moutai is A-shares listed, and it's one of the biggest state-owned enterprise. So I think the volatility is not there. But I still want to keep a Haidilao position to basically reflect my view of my sentiments towards the consumer discretionary segment. I think the consideration is also, why did I sell Tencent for Moutai and not Alibaba for Moutai? Because I think intuitively speaking, if you think about it, Alibaba is more closely related to the consumer demand. Yes, it's in the internet technology space, but really if you think about it, if the Chinese consumer sentiment picks up, people are willing to spend, people are willing to shop more, the average order volume, the lifetime value of all these customers will increase significantly. But I think largely speaking, I think selling Tencent over Baba, it's mostly a valuation concern. Alibaba is really still dirt cheap. Tencent, you can argue that it's fairly valued. Some of you might think that it's overvalued, which I don't think so. So that's why I cannot pull the trigger. So I kind of swapped out Tencent for Moutai instead of Baba. So that's generally my 2 cents. So then the biggest question is, why Moutai? Yes, I'll do a Moutai analysis in the second part of this video, but I just wanted to kind of update you. And so I just recently collaborated with Mumu, and I wanted to do a portfolio challenge or a building of a new portfolio together with you on this platform. Then some of you might ask, why? Why bother creating a new account? Why are you doing this Mumu challenge? Firstly, of course, this is a collaboration with the company. I really do love their platform and I'm personally using it. So if I do want to promote a platform, I have to be transparent about it, and I want to share my real experience as a fellow investor as well. I think secondly, which as I've noted, I kind of want to feel energized about investing again. I'm not too sure whether you have that same experience, but for myself, yes, I've been plowing in capital to my account and I'm looking at my investments grow over time. But it really feels like at some point in time, as the account size grew, every time I put in money, it doesn't look like the positions are changing, or unless I do a major restructuring or reconfiguration. If I sell a position, I buy a new one. If not, if it's through my monthly contribution, where I've shown you previously, where I just slowly buy into Google, Amazon, the position size just doesn't grow because a factor of everything, the monthly addition is not very big, so it doesn't move the needle. So it kind of make me feel a little bit adamant, or it makes me feel a bit, it's just another month, I'm just putting in my money into my investment portfolio and hoping that it compounds over time. But however, when I start a new portfolio with fresh funds, and the numbers are still manageable, whenever I add in additional funds, you can see that the portfolio size and composition actually move. So it kind of makes me feel excited and motivated about investing and finding new companies, etc. I think secondly, it's really the idea of expanding my curiosity and also my circle of analysis. I just wanted to jump the gun and share that if you do have any good investment ideas, feel free to leave in the comment section down below. I won't bite, and I'm really open to understanding and to just crowdsource investment ideas. And for myself, I've realized that I've been doing something subconsciously, where I only look at or analyze certain stocks that feed my preconceived idea of being a value stock. And I want to change that habit, because I don't want to be kind of boxed up into my framework and to think that only my way is the right way. So this time around, I'm very open to listening. And I think through this challenge, or through this idea of creating a new portfolio, it will allow me the bandwidth and capacity to look into different investment ideas, the different other types of investment styles. Of course, if you want to leave an idea down below, please make sure to at least back it up with maybe 2 investment theses and your risk factors, so that I can filter and work on the ideas together. And of course, I have to set a few rules and how I intend to build this portfolio together on this YouTube channel. Initially already had 1.13 Singapore dollars. Why, you might ask? Because it actually converted to 1,000 US dollars. I was doing some experiment, take the approach that I'm trying to build this portfolio together. So I added $10,000 and I'll build the portfolio kind of alongside the viewers and to bring you along this journey. And I want to show you the power of consistency, of being able to stick to the plan, and how the portfolio will grow over time. And I'm intending to add in $1,000 per fortnight, which is to say 2K per month, and we'll build it out together. This will probably start in January, even though I've already started allocating capital to some of these names that I see value in. And more importantly, just to show you that I'm not smoking you or anything, this is my account. You can see that if I sort it based on portfolio size or portfolio positions, Yeah, Amazon is my largest position right now. And basically, I've only started allocating capital in August of 2024. Time-weighted return of this portfolio is really 17% because clearly all the US stocks have basically been going to the moon. Basically, Momo's platform, you can use it on both desktop, which is what I'm showing you now, or on your mobile phones. So just to give you a quick introduction of how this is going to be, I think I will probably provide a fortnightly update on the Momo platform, maybe do some simple analysis, walk you through on why I buy certain stocks, whether I've sold, how I reconfigured the portfolio. You'll see in real time how I intend to build a smaller, relatively smaller portfolio. I also wanted to kind of target the group that just started investing. Maybe they're fresh grads, or maybe they are just people new to the markets, and that's how we slowly build up our size, our momentum, and our own analysis. On the Momo desktop app, you can actually go to the customs portfolio. You can create a blank new tab, and you can add the different widgets of what you crave for or what you think is important to your own analysis, creating codes, understanding what's the chart pattern. Everything is drag and drop, and you can prioritize whatever that you think is important for yourself, and everything is customizable for your own trading or investment requirement. And interestingly, they have created or added the function of a screener, where I know some people do pay for more sophisticated or very good screening softwares, but right inside the Momo app today, you can create your own screener based on a few metrics that you consider that are important. So just to give you a quick taster of how it will be, you can add the different filters on what you think is important and what kind of companies you want to see or look out for. Market cap, let's say we don't want to small caps, you try to filter out the more than 20 billion. And maybe from a valuation perspective, if you want to look for your quote-unquote value stocks, maybe your price to cash flow not more than 25 times, where you want someone that is definitely profitable and under 25 times PE. In terms of financials, you want to look at a high quality company, maybe your ROE to at least be 15%. And if you don't want to restrict yourself to the PE metric, because sometimes the earnings could be manipulated, you can kind of see that this is my own framework or my own understanding of analyzing companies. A lot of the companies here, they are in my portfolio. Amazon, Alphabet, Meta, Taiwan Semiconductor, Tencent, etc., etc. You get my point. I guess it's quite apparent as to how I think as an investor and what's my framework. So a screener helps you try to find similar in your same arena that you might probably be interested in. And a screener is just first step. Second step, you have to understand the company, etc., etc. And the screener function comes for free on the platform, and it's something that you can tap into. And for those of you who have not created an account with Momo, you must celebrate this Christmas with Momo, as they're offering a starter kit worth up to 2,266 Singapore dollars. So it's the perfect way to end 2024, with more money of course. So here's the deal. New users to Momo can now sign up for an account with my link below, and you'll get 30 days zero commission for the Hong Kong stock market, 1 year commission free for the Singapore market, and a lifetime commission free in the US stock market. Sounds good? On top of that, new users can potentially get up to 1 free Tesla share and a $20 cash coupon, which is an affiliate exclusive if you were to use my link below. And for those of you without $100,000 in capital to qualify for the highest tier of sign-up rewards, you can deposit at least a cumulative amount of 3,000 Singapore dollars and complete 3 buy trades and maintain the assets for 30 days. 3-3-30. Sounds easy to remember. You'll get $20 in cash coupon plus 0.1 Tesla shares worth roughly 47 Singapore dollars. So that's $67 worth of rewards in 30 days. 2.2% of a $3,000 capital base. Sounds like a pretty good deal to me. Furthermore, by topping up this $3,000, you also get an entry ticket to the Christmas giveaway lucky draw, where you'll get a chance to win up to $1,500 worth of trading cash coupon. And for existing users, you're not forgotten. You can choose one of the 4 tiers to complete, and it's basically depositing fresh funds into your existing Momo account and maintaining the amounts for 60 days. And you'll get rewards of varying tiers. And at the very least, depositing $10,000 worth of fresh funds, and you enjoy total rewards worth up to $30. The highest tier, $360 worth of trading coupons. And this is exactly what I'm personally doing, which is depositing $10,000 worth of fresh funds. So I'll put my money where my mouth is at. So sign up link will be in the description below, and thank you Momo for sponsoring this video. Now, to circle back to the Moutai analysis, Just a simple background briefing about what Moutai does. They are basically the crown jewel of the Chinese consumer brand. So its core product is basically just producing and selling baijiu, which is a traditional Chinese spirit. And it's currently the largest liquor company in the world by market capitalization. So Moutai is essentially synonymous with prestige and luxury in China. They are a staple for state banquets, business gatherings, and special celebrations. So Henry Kissinger allegedly quipped, "If we drink enough Moutai, we can solve anything." So usually when we talk about companies in the luxury segment, a few names come to mind like LVMH, Hermes, etc., etc. But I think to put things into perspective, Moutai, they are real luxury. So they represent status, power, and of significant cultural heritage and importance to China, as it's being passed down from its past leaders or early leaders like Zhou Enlai, Mao Zedong, etc. So they have gross margins of over 90%, operating margins of 65%, net margins of 49%, and their ROE, ROA, ROIC, which is return on equity, return on assets, return on invested capital, they are easily north of 30 to 40%. So let me repeat again, in case you missed that. Gross margins over 90%, operating margins over 65%, net margins of nearly 50%. ROE, ROA, ROIC, 30 to 40% easily. So this is the classic definition of a company in the luxury segment. So if to look deeper into the current market share in terms of the baijiu market in China in 2022, Moutai sits at roughly 18 to 19%. Is that a large enough market share? I think it's really dependent on the industry and how you look at it, because Moutai really only targets the high income segment. The dynamics or distribution of income, they wouldn't have a very big market share. More importantly, in terms of the monthly expenditure of alcohol amongst the Chinese consumer as of 2024, this is the current distribution. The classic flagship product of Moutai, which is at 500 milliliter, costs around 2003 to 2004 renminbi. That's roughly around 300 plus US dollars. And as you can see, based on this breakdown, those that actually spend more than 1,000 renminbi to over 2,000 only makes up a small segment of 9.4%. So this is clearly the segment that they're going for. And this will give you a flavor of where Moutai sits. So in terms of their business performance, to give you a perspective of their top line, their revenue, which is denoted in this blue chart graph here, very, very nice uptrend. The rich people continue spending money, even though we kind of know that the Chinese economy is not really in a very good place. Specifically, I think if you compare it to 2016, 2017, they were roughly doing around 30 to 40 billion dollars in revenue. But in the latest quarter, they are doing roughly 160 billion. So that's at least a 4x in the last 8 years or so. So another question that people will ask is the revenue growth slowing down? You can see that the revenue CAGR, if you compare it to 2017, 2018, there is definitely a slowdown, but they're still growing at a respectable, I guess, in the high teens, which is 15 to 20% range. Took a nosedive intuitively during the COVID lockdown pandemic period in 2020 to 2022, but you can see that it's slowly re-accelerating again. Now, in terms of their bottom line, these are the three metrics that I extracted: cash flow from operations, free cash flow per share, and the EPS. So EPS, which is their earnings per share, like their revenue, is growing at a very, very nice clip. I think in terms of their free cash flow per share, not their highest to date, but yeah, there is some sort of cyclicality going on there due to their expenditures. And of course, cash flow from operations, also a bit of cyclical nature, but it's still in a very nice uptrend. So I think for any investors, the first thing that they like to look at when you look at any company is to search out the stock price. So I've took the liberty to show you in the last 1 year, they're actually down 9%. In the last 5 years, they are only up 32%. But I think all time, they are clearly a very good compounder. And some of you might ask what happened. You can see that in the last 1 year, there is a huge level of volatility. Clearly after the whole announcement from the PBOC to try to support the stock market, that's when you see that very huge spike up. But from the first, I guess, 3 quarters of the year, there is a lot of consideration and risk involved, which I'll talk more about in the later part of the video. But from 1,006, it basically plummeted to roughly 1,003 or so. And then after this whole announcement, they prop it back up to 1,005. Basically the area where I decided to start a position in around the 1,005 valuation point of view. Last 5 years, I think their CAGR is also very weak from a price action perspective. I think it's max, I guess, 5%, 6%. But I think all time, if you drag it out, great compounder, but experiencing in some sort of a headwind over the past 4 to 5 years or so. So being different from other creators or analysts, people always like to put on the catalyst first, but I think for many Chinese stocks, I like to flag out the risk first, because you need to kind of know that you are playing with a different monster. Investing into the Chinese stock market is a beast on its own, so you really need to be comfortable with the risk involved or associated before you talk about the catalyst and your projections and what you expect. Because if you're not comfortable with the risk, no point trying to say that this is the next best investment opportunity. So I think the most important factor, or the first factor that comes to mind, is that Moutai is actually an SOE, which is a state-owned enterprise. So yes, it could cut both ways. The government, which is the Guizhou local government, they sit at around 60% of Moutai's equity stake. So they are the largest partner. But I believe the bigger notion of worry for many investors is that the traditional convention of being state-owned or being linked to the government is the need to do quote-unquote charity, because you are afraid that they are not really interested in building shareholder value. But like I said, I think in this specific case, it cut both ways. They don't have some sort of a golden share that owns like 1% equity, but they have veto power. But in fact, they are deep in the trenches together with Moutai, because they will also benefit from the appreciation in the share price and the dividend and the free cash flow. So I think the interest is clearly aligned here. That said, I think just to flag out recent developments, in August 2024, Moutai actually disclosed that they're venturing into the semiconductor chip space, and Smart Logic, which is the company that they invested in, is probably first of many, and they invested roughly 33,000 US dollars. Yes, the number is minuscule, but I think it just gives you a flavor in terms of the expectations of some of these SOEs and what they're expected to do to contribute to nation building in that sense. So I think China also kind of realized that state-owned enterprises are not the most innovative firms, but they probably have a lot of cash. So the new mantra for them is to move from being asset managers to capital managers, very much like being your capital arm of the government, and they serve as long-term, patient, or strategic capital. So there was this very interesting write-up from Jordan, and I'll leave the link to his Substack down below. But here is something that you have to probably grapple with as an investor to most of these Chinese companies, not only Moutai. The size of Moutai's chip investment is relatively small, though not significant news for the China's semiconductor design industry, but it plays to a bigger debate central to the future of Chinese political economy. What role can undesirable industries like alcohol, social media, online gaming play in an economy increasingly focused on national strategic priorities? So alcohol is also not the only drug whose sales revenue fuels Chinese tech modernization. So China Tobacco, controlling 96% of the domestic cigarette sales, is also effectively part of the Ministry of Industry and IT, the same ministry overseeing China's largest chip fund. So perhaps Deng Xiaoping's famous saying, "It doesn't matter whether a cat is white or black, as long as it catches mice," needs a modern update. It doesn't matter if profits come from baijiu or cigarettes, as long as they fund semiconductors. So I think it's really this very intricate relationship here that we are talking about, where some of these most profitable, largest state-owned enterprises, they have to go into investments or capital management, and they are not necessarily just solely focused on maximizing shareholder value. And that's the trade-off that you're going to get. And they still do benefit shareholders, because clearly, even as the largest state-owned enterprise, they have been proven to be a great compounder. They are in fact giving out good dividends, 2, 3, 4%, and the local government is also one of the big beneficiary of how the company managed to evolve and grow the business. But the second part of the picture here is really how do you make do, or how do you underwrite the risks that is talking about, which is this whole idea of a charity drive or being a strategic fund or strategic capital allocator for the government. Secondly, I think there are a few scandals for Moutai. Their previous chairman, Ren Guo, handing out distributor license illegally and pocketed 230 million RMB. In a period after Xi took power in 2012, he also started to emphasize on his anti-corruption campaign, and the tone in general started to ease on the lavish spending and extravagant lifestyle. So Moutai was clearly affected because it was a cultural kind of symbol for extravagance and for spending, and they were affected in 2013 to 2015. But I think after that period, they continued compounding their earnings, their revenue, and so on and so forth. And Moutai was also previously fined for breaching anti-monopoly regulations by setting price floors to distributors. And these three sub-pointers is not necessarily something new, specific to Chinese-related investment, so you need to keep your eyes peeled going into such investment ideas or opportunities. But I think I'd just like to reiterate and emphasize that Moutai managed to weather the storm, and I think it's really the idea of the capital structure, of the local government taking a very majority stake. This ensures that minority shareholders' interests are aligned with how the company is being developed there. And the very last risk that I wish to highlight for Moutai is really more business specific. So I think liquor consumption is getting soft, and we can kind of intuitively guess why. It could be due to the trying and uncertain economic outlook, and they basically wish to cut back their consumption on alcohol. Secondly, it could also be a change in taste and preferences or lifestyle, where their prices fell in 2024. The 500 milliliter flagship product is now only costs 2,300 RMB from the 3,000 RMB initially in 2023. So that is a negative 20% year on year. So right now, I hope that you are clear into what you're getting yourself into. If you're still interested in investing into Moutai, the big environment, which is a state-owned enterprise, potential regulation, potential charity, scandals being laid onto the history of Moutai, and more importantly, from a micro ground up perspective, liquor consumption is definitely going soft, and it's definitely being reflected to Moutai's core business. So now let's move on to the investment thesis of Moutai, and I also have 3 points straightforward. Firstly, I think Moutai is the stock with the biggest weighting on the Shanghai Composite Index, which allegedly cannot fall under 3,000 points. So I think I've already reflected this viewpoint over the past few episodes that the Chinese government is essentially setting some sort of a floor on equity prices. So Moutai, being the largest beneficiary of this, you probably wouldn't see another 20-30% nosedive. At least that's my baseline expectation from here. You kind of have a put covered, and this kind of works as a call option. So this is building on top of the government's focus to back the stock market, and they're also enabling buybacks and trying to prop up and to gather that kind of wealth effect so that the Chinese people feel rich again, so that they will drive that whole flywheel of consuming and being hopeful about the economy. Secondly, I think the company has also started to sing the same tune by trying to reward shareholders, where they plan to give cash dividends of no less than 75% of their yearly profit from 2024 to 2026, and they made a public commitment on that. And more importantly also, in September of 2024, they also launched their first ever share buyback or repurchase program of $425 million. So yes, it's minuscule, but I think I'm just picking up some of these references and to see that, hey, they are really listening to what the central government is saying, they are progressing or developing in the right direction. So from a macro point of view, I do think that Moutai do have quite limited downside, and I want to sit on the right along of buying such a high quality company, and also with the backing of the government and how they are trying to posture and position the Chinese stock market moving into 2025. Secondly, I think Moutai as a luxury consumption product also gives you a very specific exposure to the high or very high end of the China consumer segment. So they have unmatched branding power with very strong cultural association. They also have limited supply, strong pricing power, and they are very focused in terms of their market penetration. Of course, if your baseline projection or assumption for the entire Chinese economy out into 26, 27, 2030, you would expect the Chinese recovery story to play out. And I think for luxury products specifically, they are the most prime to take advantage of this growth trajectory. Simply put, buying a very high quality company that has very high brand awareness and pricing power, buying at a very depressed state for very good reasons in the current macroeconomic conditions. Thirdly, I think with those margin numbers, Moutai actually make Hermes look cute. Yet, from a valuation point of view, I think Moutai is still trading at a relatively interesting and attractive valuation. So they are currently trading at around 20 times PE, while Hermes, from a margin point of view, lose Moutai on all fronts, but they're trading at over 50 times. So just some perspective on their current valuations, from a price to earnings to growth, PEG, they are at 1.7 times. I'm not too sure how they crunched the number, but the last time I looked at it, based on my recollection, they're closer to 1.5 times. 1.5 times PEG, is that expensive? Some people say that you want to buy below 1 times PEG, but just looking at the historical performance of Moutai, they've only traded below 1 times PEG during the 2018 to 2020 era. Now, moving on to price to free cash flow, they're trading at roughly 33 times. And you can see that over the last, I guess, 7 years or so, their valuations has started to pick up as investors are trying to bid up and trying to tag a premium to their valuation. So I think it's up to you to decide on where you want to take the median, but I think at 33 times price to free cash flow, they are trading at a lower side or lower bound of the range. The price to tangible book value currently at 8.3 times, also at the lower bound of a relative valuation. And lastly, price to operating cash flow at 31 times. For such a high quality company, yes, sometimes you like to look at 12 times, 15 times, 20 times. I'm willing to pay up, and I do think that at current valuations, Moutai is probably closer to fair value, but still on the undervalued front. And yeah, on top of that, there are several catalysts that I look forward to. So I think investing into Moutai, the bottom line is simple. You are buying into a really high quality business, someone with great track record and fundamentals, if you look at the rear view mirror, meaning to say you look at the last 5 to 10 years of how they performed. But they still definitely come with their own set of challenges, both from a macro and micro perspective in the current environment and the entire space that they're operating in. So please do proceed with caution and to a point where you're only comfortable, and size your position accordingly. So this is not financial advice, and I hope you enjoyed this entire discussion, and thank you for watching. So with that, I hope to see you in the next video, but more importantly, I hope to see you on the moon. Goodbye.